A crucial aspect of understanding economic downturns is the distinction between global recessions and recessions affecting individual countries or regions. While economic slowdowns are relatively common occurrences within specific nations or economic blocs like the European Union, a true global recession is a far rarer phenomenon. Even during periods where a large group of countries might be experiencing economic hardship, there's often another region or nation that bucks the trend and exhibits growth. A prime example is China's economic expansion during the 1970s, even as many other countries faced recessionary pressures. This distinction is critical because a genuine global recession signifies a widespread decline in global gross domestic product, GDP, the total value of goods and services produced globally. These events are uncommon, but when they do occur, the impact can be devastating. The financial crisis of 2008 and the worldwide lockdowns implemented to combat the COVID-19 pandemic in 2020 serve as stark illustrations of global recessions. These events triggered widespread economic hardship across the globe, highlighting the interconnectedness of the modern world economy. To grasp the current economic landscape, it's imperative to dissect the performance of major economic powerhouses, beginning with the United States. In the first half of 2022, the U.S. economy entered a technical recession, defined by 2 consecutive quarters of negative GDP growth. While the initial impact of this recession was relatively mild compared to historical downturns, certain key indicators suggest a potentially deeper and more prolonged downturn may be on the horizon. Rising unemployment rates, a marked slowdown in industrial output, and a decline in retail sales all point towards a worsening economic situation, signaling that businesses and consumers are feeling the strain. Adding to the complexity of the situation, there has been a significant drop in inflation within the U.S. This development carries substantial implications for investors and could have a major impact on the Federal Reserve's monetary policy decisions. If the decline in inflation persists, the Fed might consider reducing the pace or even halting interest rate hikes. Such a move could offer some relief to heavily indebted businesses and consumers by lowering borrowing costs. However, a cautious approach is essential. The potential for a more severe recession remains a significant concern, and its impact on the stock market and broader investment strategies should be carefully monitored. A deeper recession could erode corporate profits, leading to stock market declines. Investors need to be prepared for potential volatility and adjust their portfolios accordingly, focusing on strategies that can weather economic turbulence. It's crucial to stay informed about the Fed's actions and evolving market conditions, as shifts in monetary policy and economic news will continue to shape investment opportunities and risks. A fascinating divergence exists between market expectations and the current economic landscape. Some investors believe the Federal Reserve will pivot and begin lowering interest rates due to recent decreases in inflation. However, this seemingly positive development could hold negative consequences for stocks. Historically, a pivot towards lower interest rates often coincides with more severe recessions, suggesting the market might be underestimating the potential economic downturn ahead. It's essential to grasp that lower interest rates, while typically a positive sign, can sometimes be a symptom of a deeper economic malaise. If the Federal Reserve feels compelled to reduce rates aggressively, it could signify the economy is in worse shape than anticipated, leading to a significant decline in corporate profits and a corresponding drop in stock prices. Therefore, investors should be cautious and avoid overly optimistic interpretations of falling inflation rates within the current economic climate. Investors hoping for reassurance from the Federal Reserve may be disappointed. The Fed's track record in economic forecasting paints a concerning picture marked by missteps. Despite previous signals that they aim to tighten monetary policy, indicators of a looming recession are now becoming increasingly apparent. Worryingly, the Fed has a tendency to miss or misinterpret these early warning signs, potentially delaying policy responses until the situation worsens. Shifting our focus beyond the United States, we encounter widespread anxieties concerning a potential global liquidity crisis. Despite the Federal Reserve's aggressive quantitative easing programs, a surprising phenomenon has emerged: a global shortage of US dollars. This scarcity is further aggravated by the astronomical amount of derivatives circulating in the financial system, estimated to value a staggering $1 quadrillion. Derivatives, complex financial instruments, often require collateral to mitigate risk. During periods of economic turbulence and liquidity crises, banks become increasingly cautious about the types of collateral they accept as a guarantee for loans. In these situations, highly liquid assets like short-term US Treasury bills become highly sought after. This flight to safety can exacerbate the dollar shortage as banks prioritize US Treasuries over other forms of collateral. This dynamic can have significant repercussions for financial stability. Companies and institutions with non-dollar assets may find it difficult to secure loans, hindering investment and growth. The potential consequences of this global dollar shortage are severe. If this situation persists, it could precipitate a full-blown global financial crisis and a severe recession in the near future. A central factor in mitigating this threat lies in the Federal Reserve's actions. The Fed must carefully navigate the economic landscape, ensuring adequate dollar liquidity to lubricate the global financial system without fueling excessive inflation. Striking this delicate balance will be critical to preventing a financial meltdown and fostering a stable economic environment. The current analysis of economic indicators paints a troubling picture. Multiple factors suggest a looming global recession could drastically reshape the investment landscape and test the resilience of policymakers. Forecasts indicate a convergence of negative trends that could severely impact economic stability, making this a precarious moment for investors and those charged with economic management. A potential liquidity crisis further complicates the situation. Shortage of readily available capital, particularly the US dollar, threatens to destabilize financial systems. During turbulent times, investors and institutions naturally seek the safest assets, exacerbating this imbalance by prioritizing specific types of holdings. This can lead to a cascading effect where access to essential funding becomes restricted, potentially triggering a chain reaction with severe economic consequences. In summary, the outlook for the immediate future is fraught with significant challenges and uncertainty. Investors must exercise caution and closely monitor the evolving economic environment, staying up to date on any new developments. Policymakers also face a formidable task, requiring them to carefully navigate a landscape fraught with risks. Proactive and informed decision-making will be crucial in the coming months and years to mitigate the potential damage of an economic downturn and to chart a path towards a more stable future.